Governments love to tell you they're working for your financial freedom. They talk about stability, growth, and opportunity. But if you look closely at history, you'll see something much darker. Governments have always used hidden financial tricks to keep ordinary people poor while hoarding wealth and power for themselves. And the shocking truth is, these tricks are not new. They've been recycled for centuries, wrapped in new packaging, sold under new names, but always with the same goal: to transfer wealth upward and keep the majority dependent. The oldest and simplest trick: inflation. When a government spends more than it can collect in taxes, it has two options. Either admit the truth and tax citizens openly, which is politically dangerous, or quietly debase its currency, reducing the value of every coin and every note in circulation. Ancient Rome mastered this trick. In the 3rd century AD, emperors facing huge military expenses reduced the silver content of the denarius. A coin that was once nearly pure silver became mostly copper, coated with a thin layer of silver. The empire pretended nothing had changed, but everyone holding those coins paid the price. Prices soared, savings evaporated, and wages couldn't keep up. It was a silent tax on the people, the same trick still used today, only now through central banks instead of imperial mints. Forced loans in England, France, and Spain. Monarchs routinely forced wealthy merchants and guilds to lend money to the crown. Of course, these loans were not voluntary. Refusal meant fines, confiscation, or worse. Sometimes the crown promised repayment with interest, but it often came late, in devalued money, or never at all. The government kept its wars and palaces running, while merchants had no choice but to surrender their capital. Coercion was disguised as patriotism and duty, and it worked for centuries. When finance became the trick, when the Bank of England was created in 1694, it wasn't out of charity. The government needed money to fight wars with France. Wealthy investors bought government bonds in exchange for guaranteed interest funded by taxes. But who paid those taxes? Ordinary people through levies on salt, beer, and cloth. The rich lent money to the state and earned safe returns, while the poor paid higher taxes to fund those profits. It was a system of wealth transfer disguised as national finance. And it established a pattern still alive today. The safest investments in the world are lending to governments, and the returns are guaranteed by the labor and consumption of the masses. Same tricks, new names. Look at deficit spending. Governments issue massive amounts of debt, bonds bought by investors, banks, and foreign powers. Politicians tell the public it's for infrastructure, jobs, or social programs, but much of it flows into defense contractors, corporate subsidies, and bailouts. When it's time to repay, governments don't cut from the top. They raise taxes, inflate the currency, or cut social benefits. The trick is that debt appears to be for the people, but the burden falls on their shoulders while the profits go to bondholders. Bailouts. During the 2008 financial crisis, banks made reckless bets on toxic mortgages and nearly collapsed the global economy. Who paid for it? Ordinary taxpayers through massive government bailouts. Who profited afterward? The same banks, which emerged bigger and stronger than before. The trick was simple: privatize the gains, socialize the losses, and convince the public it was necessary to save the system. Pensions, the quiet deception. For decades, workers in the US, Britain, and Europe paid into government-managed retirement systems, trusting the money would be there when they retired. But governments often don't actually save that money. They spend it immediately, leaving IOUs in its place. The promise is that future taxpayers will cover the costs later. It's essentially a generational Ponzi scheme wrapped in official language. And when demographics shift and populations age, the system becomes unsustainable. Then comes reform: reduced benefits, higher retirement ages, or inflation-eroded payouts. The repeating pattern. At every stage, the trick depends on perception. Inflation is called growth. Forced loans are called duty. Debt is called investment. Bailouts are called stability. Pension cuts are called reform. Language hides reality, a transfer of wealth from the many to the few. And this pattern has worked for centuries because most people don't study economic history, don't understand finance, and don't see the trap until it's too late. Modern tricks since 2008, new terms have appeared, like quantitative easing. It means central banks created trillions of dollars out of thin air to buy bonds and inject liquidity into markets. They said it was needed to save the system, and it did for the financial system. Asset prices, stocks, real estate, bonds, all surged. But who owns those assets? The wealthy. For the average person, the benefits were minimal, while the downside came in higher living costs. The trick? Money creation saved the top while fueling inflation and inequality for everyone else. Stealth taxation. Instead of raising income taxes openly, governments quietly tax through sales taxes, fuel duties, and most of all, inflation. When prices rise faster than wages, that gap is a hidden tax on purchasing power and savings. Governments love inflation because it reduces the real value of their debts, but for citizens, it erodes financial freedom. You may feel richer because your paycheck is higher in numbers, but if your costs rise faster, you're actually losing wealth. This isn't a flaw in the system, it is the system. Financial complexity as a weapon. Tax codes thousands of pages long, financial instruments few can explain, budgets buried under jargon and line items no one tracks. This makes it almost impossible for citizens to follow the money. In ancient Rome, debased coins were a visible sign of deception. Today, the fraud hides in spreadsheets and balance sheets. The trick hasn't changed. Make it too complex to understand, and the transfer goes unnoticed. Endless war finance during World War I and II, governments issued war bonds, calling it patriotic duty. But they were also risk-free investments for the rich, guaranteed by future taxpayers. In the 21st century, the same pattern repeats. Trillions spent on wars in Iraq and Afghanistan, benefiting defense contractors, banks, and bondholders, while ordinary taxpayers carry the debt. Wars are presented as temporary crises, but the financial burden lasts for generations. The harsh truth. Every time people forget history, the trick returns. When Rome debased its coins, citizens suffered. When kings forced loans, merchants lost fortunes. And today, when modern states print and borrow, households pay the price. Different ages, same mechanism. And most people will never escape it because they don't realize they're being played. The final lesson. Governments and elites prefer a financially uneducated public because ignorance is the most powerful trick of all. But financial education is resistance, and economic history is a weapon. If you understand the tricks, you're harder to manipulate. Don't believe the headlines. Always ask, who benefits first? When inflation rises, remember, it's not bad luck, it's policy. When new regulations appear, ask, who wrote them and who profits? Build real wealth outside the traps of the system. Never assume the system works for you, it works to protect itself. History doesn't repeat exactly, but if you fail to understand it, it will crush you just the same. The financial tricks that kept Roman citizens poor are the same ones draining your account today, only dressed in modern language. The only difference is, will you recognize them in time?